It's finally happening. Warren Buffett is retiring as the CEO of Berkshire Hathaway, but not before issuing a direct warning about the strength of the US dollar and how risks at the center of the US economy could threaten the stock market for years to come.
We wouldn't want to be owning anything that we thought was in a currency that was really going to hell. And that's the big thing we worry about with the United States currency. The value of currency is a scary thing.
Buffett's latest trades to see what he's doing with his money and how his new warning echoes the same fear she had in 2003, before we saw a decade of the dollar declining and U.S. stocks delivering 0% real returns for 10 years, a lost decade for the market. And then we'll walk through the exact playbook Buffett used to profits billions back then, and how smart investors can apply today without just copying a billionaire's trades. So this is Berkshire Hathaway's 13 Feeling. It's a document that lists all the stocks that a company owns and the trades that they're making. It's like a cheat sheet for what Buffett is buying. At the 2025 shareholder meeting, he made a point of highlighting one move: Berkshire's massive bet in 5 Japanese companies not using dollars, but buying them by borrowing in Japanese yen. And that caught investors' attentions because that's not just a stock bet, that's a currency beta. And Buffett thus explained exactly what this move means. See, back in 2003, during his last major move with foreign currencies, Buffett wrote, "To hold other currencies is to believe the dollar will decline." In other words, he's not just buying some undervalued stocks, he's making a bet against the strength of the US dollar. And coming from a guy who has always said, never bet against America. That should make every investor's to at least pay attention, because if we look at this story, the last time Buffett made a move like this, the US dollar fell for years as stocks went, where after inflation, and Buffett made billions. Historically, betting against Buffett has been an extremely expensive mistake, and history has a lot to tell us about what's coming next. So back in 2003, Buffett wrote this editorial for Fortune magazine warning that the US dollar was at serious risk, just like the warning he's making right now. Now, this was crazy even at the time, because Buffett had already had a pretty long career, and he had never once bet against the growth of the US stock market. Until now, at the time, some investors dismissed him, but Buffett doubled down, saying, "We think over time that the dollar is likely to decline in value against some of the major currencies. This is not a short-term prediction." In April 2004, this report to Congress confirmed that the dollar had declined 7.9% against the major G7 currencies. Buffett had been right, and Berkshire ended up profiting $2 billion from that one trade during a time when the market returned an annualized return of only 2% less than inflation, the so-called lost decade of investing that I covered in my last videos. So all this just goes to show that when Buffett sees a structural risk in the system, like the one he's calling out today, he doesn't just talk hacks, and in 2003 that call proved to be exactly right. But Buffett's bet today is based on very different risks than in 2003, and since Buffett is famous for staying calm and holding through chaos when he starts making bets against the dollar, while most of the market is bidding up stocks, it's worth asking why and figuring out what this means for us regular investors. And it all starts with maybe the most intentionally boring term in investing: fiscal policy. But this might also be the most important concept for investors in the next decade.
Fiscal policy is what scares me in the United States. The natural course of government is to make the currency worth less.
So fiscal policy is just how much the government spends versus how much it collects in taxes. The U.S. has run a deficit almost every year for decades, borrowing to make up the gap in the budget. And while that might just sound like an abstract budget issue, it can have a big impact on investors, because when fiscal policy is strong, it often supports bull markets, and when it breaks down, it can trigger periods like 1970 stagflation or long stretches of underperformance. This chart shows it pretty clearly. The blue bars represent how much the U.S. borrows each year to stay afloat, and the line shows the total debt that is built after a brief surplus in the late 1990s. Borrowing picked back up, and the U.S. hasn't stopped borrowing since. Now running a deficit isn't always bad. This is an older chart that shows U.S. borrowing spiked during World War II, but afterwards strong economic growth helped pay that debt down, and the decades that followed were some of the most prosperous in American history. And Buffett then argues that a deficit of around 3% of P is fine, so 3% of the country's total economy each year, and in some years overspending, can even be justified, like in the 2008 financial crisis. Warren Buffett supported federal spending to help stabilize the economy, but starting in 2020, something changed in 2020. Government borrowing jumped to nearly 50% of the entire GDP of the U.S., the highest we've seen since World War II. And while that was a spike up and down, federal spending has stayed higher than normal ever since. This year alone, the U.S. has spent $1.3 trillion more than it took in, and that is almost 10% more than the government borrowed last year. But what's alarming to Buffett, and what could actually affect investors, isn't just how much we're spending, it's where that money is going. When you look below the surface, because if you borrow something, you expect to get something back. Infrastructure, innovation, economic growth, but a growing share of the budget is being spent nothing new at all. So in 2019, we can see in this P chart that 8% of all federal spending went just to pay interest on debt. By 2024. It was 13% of the budget, and if we stay on this path, projections show that by 2047 of every federal dollar will go to interest payments before a single dollar reaches a school, road, or hospital. This is Ariel projection from the Government Accountability Office, a nonpartisan governmental body whose job is to audit federal spending for Congress. It's how the national debt is expected to rise exponentially from here, eventually surpassing 2.5 times the entire GDP of the country. And once it gets going, it's really hard to fight an exponential now. You might say, okay, this sounds bad, but it's the US government. They can just print more money. And historically, that's been true. Buffett said in 2003 that the US enjoyed a special status and that we can behave today as we wish because our past financial behavior was so exemplary. But our past behavior can't carry us forever. Buffett now calls this kind of spending unsustainable and warns that if it goes on long enough, eventually it becomes uncontrollable. Now, Buffett's not trying to time the market here. He's pointing to what the data already shows. The further we stray from sustainability, the closer we get to losing control. And the impact of all this debt doesn't just show up in budgets, sits up in the dollar itself, which eventually spreads to the US stock market. And that is where Buffett's warning gets sharper. So what exactly is the big risk here? Are we just talking about inflation? Well, debt can fuel inflation. If you inflate the money supply, your debt is worth less. $1 billion in debt was a lot during World War II, not so much anymore. But while inflation can be very painful, if wages don't keep up from an investor's perspective, it's not enough to crash the stock market. Stocks are often used to protect your investments against inflation, so the deeper risk behind all this debt shows up in a less well-known metric. And it's a metric that we know Buffett has watched before. This chart shows the DXY index over time. The DXY index track shows strong the US dollar is compared to a basket of major global currencies. When the DXY drops, it means the dollar is falling behind globally. And here's why that matters to investors. When the dollar weakens, foreign investors start backing away from US stocks, because even if those stocks goop, the weaker dollar ends competing into their returns. And this drives investments out of US stocks and into international stocks, pushing US stock prices down. So for regular investors who own mostly US stocks, we don't want to see the DXY start to decline. But we can see that the DXY tends to follow these 10 to 20-year cycles of growth and decline, with the last big decline occurring right during Buffett's 2003 beta against the dollar. And we know what happened to the stock market during that time. But today, versus 2003, Buffett's tone is different. He's not just watching the data, he's warning us that the value of currency can be a scary thing. And if you picked up a way to screw up the United States, it would involve the currency. And now, with Buffett making moves that look eerily like 2003 all over again, the question is, what exactly is he seeing that we're missing? In part 2, we break down his next billion-dollar move and the playbook smart investors can use today.